All right, listen, before Thursday even gets going, there's one thing I want you to keep on your radar if you follow silver. It's not a rumor, it's not a viral headline, it's not some guy on social media yelling short squeeze, it's one report. And if silver is entering a real high volatility phase, this report is one of the fastest ways to see whether the market is tightening or whether the hype is outrunning reality. So here's my Thursday COMEX check: what it is, what I look for, what would make me say, okay, this could get explosive, and what would make me say, this is just another noisy swing. Because tomorrow, silver doesn't need a big news event to move hard. All it needs is a thin moment, crowded positioning, and a little push. And then the market does what it always does in a volatility regime. It overreacts first and explains later. We're not looking at typical volatility here. Three things happened that changed everything. First, silver just reminded everyone it can still move like a wild asset. When you get a strong move in a short window, it does something psychologically. It pulls people back in. It reactivates the FOMO crowd. It also squeezes anyone who was leaning the wrong way. And it forces market makers to adjust. That's not a sentiment story. That's mechanics. If you're in a market where a lot of activity is leveraged, and silver absolutely is, then a sharp move tends to create sharp aftershocks. Thursday becomes less about will it go up or down, and more about how violent will the swings be. Second, in a market like silver, paper behavior and physical reality can drift apart for a while. But when they start converging again, you get fireworks. Most people don't understand this. They think silver is one price. It's not. There's the price that trades fast. Futures, ETFs, leverage products, all the stuff that reacts instantly. And then there's the physical side. Bars, inventory, delivery capability, the can you actually source metal at size question. Those two worlds don't always move in sync day to day, but when volatility rises, everyone starts asking the same uncomfortable question. Okay, if someone really demanded delivery at scale, how tight is this thing? Third, when the market gets nervous, it starts looking for proof, not opinions, proof. And one of the most proof-like data points for silver traders is what's happening inside COMEX warehouse stocks and delivery mechanics. That's why Thursday's check matters, not because it predicts the future perfectly, but because it tells you if the market is building pressure, or if it's just price action with no real squeeze behind it. Here's what they're not showing on CNBC. My Thursday COMEX check is basically three buckets. Bucket number one, total warehouse stock trends, and the split that matters. People toss around COMEX inventory like it's one number. It's not. The categories matter. There's metal that's eligible, meaning it meets specifications and is stored in approved warehouses. And there's metal that's registered, meaning it's actually available to meet delivery obligations. Now, I'm going to keep this simple. You can have a lot of eligible metal and still have a tight market if registered inventory is shrinking or not growing when demand is rising. So tomorrow, the question isn't, is inventory high? The question is registered metal staying healthy, or is it draining? Because registered is where the delivery conversation gets real. And when registered inventory starts slipping while price is acting jumpy, you're looking at the kind of setup where small triggers can create big moves. Bucket number two, daily changes that look small but tell a story. A lot of people ignore daily changes because they look boring. But in volatility regimes, the boring line items become the early warning system. You want to see patterns like repeated withdrawals, or registered category declining over multiple updates, or sudden shifts where metal is moved between categories. And here's the nuance that separates serious analysis from clickbait. A single day doesn't prove anything, but a pattern does. If you see a consistent drift that suggests metal is leaving or not being re-registered, that's when you pay attention. Because in real markets, stress doesn't show up as one dramatic headline first. It shows up as small, persistent pressure that eventually forces a repricing. Bucket number three, delivery and intent psychology. Even if you don't trade futures, you need to understand this part at least at a basic level. Silver futures are a promise structure. Most of the time, those promises are rolled, closed, cash settled, or netted out. That's normal. But when participants start caring more about delivery, or when they suspect delivery could become harder, behavior changes. And behavior changes can be enough to move price violently. Because then it's not just traders trading, it's people trying to secure access. And markets reprice access fast. Now, I want to tie this into Thursday specifically because tomorrow is where people get it wrong. They wake up, they see price moving, and they search for the headline. Why is silver up? Why is silver down? And they get fed a clean little story. Dollar up, silver down. Dollar down, silver up. Fed speak, inflation data, geopolitical headlines. Sometimes those stories are true, but in high volatility phases, The real driver is often positioning and structure, and the headlines are just the excuse. So tomorrow, here's how I personally think about it. If silver starts moving hard early in the session, I'm not immediately asking, what's the news? I'm asking, is this a squeeze-style move, a stop-run move, or a real demand move? And COMEX-related data, warehouse stock behavior, category shifts, and delivery chatter helps you form an educated guess. Now let's talk technicals in plain language, because Thursday is all about key zones. So I analyzed the market behavior, and here's what jumped out at me. When silver is hovering around that low to mid 80s zone after a sharp move, it becomes a psychological battleground. If silver holds that zone and you start seeing dips bought quickly, it means buyers aren't waiting for a perfect entry. They're stepping in. If silver loses that zone and it gets sold fast, it means the market still has weak hands and leverage that can unwind. In a high volatility regime, you can get both in the same day. That's why you can't treat Thursday like a normal session where you check the price once at lunch. This is the kind of environment where people get chopped up because they don't respect how quickly silver can swing when liquidity is thin. Now fundamentals, because COMEX talk without fundamentals turns into conspiracy content, and that's not what we're doing. Now let's talk about the fundamentals, the real supply and demand picture. Silver has industrial demand that doesn't disappear just because price gets scary for a day. Electronics, energy infrastructure, manufacturing. Silver is a utility metal as much as it's a monetary metal. And supply doesn't respond instantly to price because a lot of silver is produced as a byproduct of other mining. So when demand perks up and investment demand re-enters, supply can't just turn on a faucet. That's why these tightness conversations never fully go away. But again, I'm going to be honest with you. A tight market doesn't mean price goes up in a straight line. It means price has the potential to gap, spike, and overshoot, both up and down, because the market is trying to discover the true clearing price in real time. That's what volatility is. It's price discovery under stress. We've seen this exact pattern before. In 2020, people learned the hard way that liquidity can vanish when everyone tries to do the same thing at the same time. You got violent moves that didn't make sense if you were only reading headlines. In 2011, silver showed the world how quickly momentum can take over and how brutally it can reverse when leverage unwinds. And in both cases, the pattern wasn't up forever or down forever. The pattern was instability first, then a shakeout, then a clearer trend. So if you're watching silver right now and thinking, I just want a calm trend, I get it. But that's not what this market usually gives you when it's transitioning. It gives you a fight. It gives you volatility. It tests conviction, patience, and risk control. And that's why Thursday's COMEX check matters. It's one of the few ways to keep your brain anchored in reality while price is trying to throw you around emotionally. Let's talk about what this means for you in real life. Let's make this personal. If you're a silver investor, volatility is not just an opportunity, it's also a hazard, because volatility increases the odds that you'll do something impulsive. You'll chase when it's ripping. You'll freeze when it's dropping. You'll sell when you're scared, then buy back higher because you feel regret. That cycle destroys people. So tomorrow, even if you don't care about COMEX details, you should care about what the COMEX check represents. It represents discipline. It's a routine. It's you saying, I'm not going to be governed by the candle of the hour. I'm going to look at structure. And here's a simple way to frame it. If silver is moving hard tomorrow, and you see signals that the physical side looks tighter, registered category weakening, persistent withdrawals, pattern behavior, then it suggests stress could be building under the surface. If silver is moving hard and the warehouse data looks stable, it suggests the move could be mostly positioning and leverage, still tradable, still meaningful, but different. Either way, you avoid the biggest mistake, assuming every move is the big one, because the market doesn't announce the big one in advance. It sets the stage quietly, and then it triggers suddenly. Look, the question isn't whether Thursday will be volatile. The pattern is clear. When silver starts acting like this, volatility is part of the package. The real question is, are you positioned for what comes next? Not just financially, mentally. Because if you're going to follow silver, you need a process that keeps you rational when everyone else is emotional. You need a checklist that keeps you from chasing noise. And for me, the COMEX check is part of that checklist. This is educational content, not financial advice. Do your own research. Consult licensed financial advisors before making investment decisions. These are market observations and analytical frameworks, not buy or sell recommendations. But the data tells a story. If tomorrow's report starts showing tightening signals while price is already swinging, that's when the volatility regime can turn into something much more dramatic. And if it doesn't, that's still useful, because it tells you not to overreact to every spike. All right, before you go, 3 quick things. 1. Drop a comment below. Tell me where you're watching from and give me your prediction. Where do you think silver is headed by the end of this month? 2. If you're not subscribed, hit that button now. I'm putting out unfiltered analysis consistently. And listen, I'm fighting copycat channels stealing this content. If this video provided value, comment, "Truth wins," so the algorithm knows you're here for the original. 3. Next video drops soon, and I'm covering the one trigger that tends to show up right before silver makes its sharpest moves, when volatility is already elevated and the crowd is leaning the wrong way. You won't want to miss it. See you there.